All right, hello everyone and welcome. Now, a lot of people starting out investing, when they're not really knowing where to go, what stocks to buy, they're going to tend to lead to the ETFs, the exchange traded funds. You're going to go onto their website, you're going to see all this writing, definitions, facts and figures, but you might not really know what they're talking about. Now, this video is going to show you the main things that you have to look for when making an informed decision on what ETF is right for you. So what I'm going to do, I'm going to go onto the websites of two of the major players, being Vanguard and BlackRock, and I'm going to look at some of the ratios you're going to see, such as price to earnings, price to book, and what that means. We're also going to look at your earnings per share, dividend yields, market cap. We're going to look at beta ratios, alpha ratios, standard deviation. I'm going to give a brief overview of all these things and what they mean, so that when you look at the number, you can say, yeah, okay, I know what's going on there and I can make the right decision. And then we're going to do some screen records. So I'm basically going to jump onto their website. We're going to go through the whole page. I'm going to talk through what I'm seeing and what it means to me and what you should be thinking about. Of course, this is not investment advice. This is basically things you need to look at when making a decision for yourself. If you're not sure what to do, then I encourage you to seek financial advice yourself. But these are just some of the basic tools that will help you to come to a decision. All right, let's get into it. Okay, so here we are on the Vanguard website. So what I've done is I've gone into Google and I've typed in ASX VAS, and that's brought me to this page here. Or you could type in Vanguard and come straight here, or type in Vanguard VAS, and that will bring that up in the results as well. So it's easy enough to get here, and here we are. So we've got the VAS, Vanguard Australian Shares Index. Now if we scroll down, we can see a bit of a description here. So it tells us that this seeks a return or track the return on the S&P ASX 300 index. So this is a little bit broader than the ASX 200 that you see quoted on the news at night. This is the top 300 companies, and it's a little bit narrower than the All Ordinaries that you would have heard about as well, which is the top 500 companies. So this is in the middle of the ASX 200 and the All Ordinaries, and representing the top 300 companies that are listed on the ASX. So if we scroll down, it tells us a bit of an overview here. Provides a low-cost, broadly diversified exposure to Australian companies and property trusts on the ASX. Offers potential long-term capital growth along with dividend income and franking credits. Some suitability here. Benefits. Diversification, because you're owning 300 companies or a piece of 300 companies. Low-cost investing and some of the risks. Now, what else I would look at here? What have we got? 0.1% management fee, which is quite low. That's good. We've got your net asset value here. Now, your net asset value is basically the value of the assets of the investment. In this case, the underlying shares, the 300 companies that this ETF owns. So you've got the value of the assets minus the liabilities, divided by the number of shares on issue. So basically what your net assets are per share is this figure here, 90. So if you add up all the assets of all the 300 companies, take away all the liabilities and apportion that across the number of shares, you're looking at $96.23 per share. Now you can compare the net asset value to what it's trading at on the ASX. When you're looking at different stocks and LICs and things, that can be a bit of a difference. ETFs, as we'll have a look here, an ETF is said to trade at a discount when its price is below net asset value. So if it's trading, if you're going to buy it on the ASX for a little bit lower than what the net asset value is saying here, that means you're buying at a discount. And if you're trading on the ASX at a higher amount here, that means you're buying at a premium. So it says here, premiums and discounts are usually negligible for the majority of ETFs, but they can be large during volatile times. So we'll come back to that a little bit later. Now, if we move along to the other heading up here, portfolio, we can see it's got 312 holdings here, so slightly more than the 300 that's on the the ASX 300, and you can see here even the benchmark ASX 300 only has 296, so it's close but not exact, and that might be due to some rebalancing, due to perhaps some companies have entered the top 300, some companies have left the top 300 and they haven't quite rebalanced to that, but it's pretty close. The market capital, $38 billion, your equity yield dividend, so this is basically, you can look at it like an interest rate as far as dividends go. So if you buy $100 worth of VAS, you can expect to make $2.82 or 2.82% in dividends paid out on your stock. Price to earnings ratio. Now this is basically exactly what it says. It's the price for what it's trading at divided by the earnings per share. So here we've got a multiple. This basically means we're trading at a multiple of 18.34 times of earnings. And that means if your earnings is $1, you're basically trading at $18. So 18.34 times. Now, if your price happens to go up, but your earnings have stayed the same, that's going to mean that this number becomes bigger, which may tell you that it may be overpriced. Also, if your price goes down and your earnings stays the same, so your earnings is solid, but your price is going down, so it's looking cheap, that means this number is going to go down, which also may tell you that it's undervalued or it's looking cheap. On the other side, if your price stays the same and your earnings go up, that's going to mean that this ratio comes down and it also looks cheap. If your price stays the same and your earnings goes down, this number is going to go up, and again it's going to look overvalued or expensive. So that's what you do with this. And another thing I'll show you is, I won't show you on this one, I'll show you on another one, but the long-term average on the Australian share market for PE is about 14, 15, probably more like 15 these days. So this is probably telling you that the market today might be slightly overvalued. If we were going to say the long-term average was 15, when comparing it, I should say, to the long-term average. If the long-term average was 15 and this was 18, this would say that it is slightly overvalued. Not by too much, but by a little. But of course, you've got to take into account the current economic climate. So you might be looking at interest rates at all times low, which tends to push the price of shares up, and also quantitative easing, which tends to pump up the share prices as well. Moving on, we've got price to book ratio, 2.38. Now this is similar to the price to earnings, but instead of comparing the price to the earnings per share, it compares it to the book value per share, which is basically the value of the company, the total market cap of the company, divided by the shares when they were last reported. So it was probably the end of the last financial year when they issued their annual report. They would have had a book value of the company, which is the assets minus their shares. Sorry, the assets minus their liabilities to get the net assets, which is the total book value. And then they've divided it to get on a per share basis to get the book value, and then they compared it to the price. So basically this is saying if the book value was $100 million, then the price would be, or the market cap of that particular share would be trading at $238 million. But then you drop it down on a per share basis, of course. Return on equity. Now this is basically the return based on the equity in the company. And we've got a bit of you can hover over these labels here and click on them for more detail, and we'll see what they tell us here. The return on equity is a measure of how much profit a company generates relative to its shareholders' equity. So how much equity or how many shares are on issue, that would give you a figure. Say that's 100 million. And if the company's made a profit of 12.74 million and the equity is 100 million, that means you've got a return on equity of 12.74%, which is quite good. Earnings growth rate is basically how much earnings are growing. Earnings per share growth for a given company and share, weighted average growth across its share. So what the growth rate is per share is 4.442%. So the earnings are growing at 4.42% per annum. The turnover rate is just how many shares have to be basically moved out, sold off to rebalance at the end of the rebalancing period to keep the 300 companies that are in fact the top 300 in the index. Sector allocation. So we're at 29% financials, that's your banks. 19% materials, that's your miners, your BHPs, your Rios, your FMGs. So as you can see here, about 50% of the VAS ASX 300 is made up of banks and miners. That's quite a big chunk. And then going down, you got healthcare, consumer discretionary, real estate, and so on. So you can see exactly what you're getting there as far as this sector goes and what's in the benchmark and how close it is. And you can see it's pretty close to the benchmark. And now we've got region exposure. So the Pacific, that's our region where Australia is, where we're domiciled. We got 97.7%. As you expect, that'd be pretty close to 100% because this is the VAS index, unless there were Australian companies that had, I guess, investments in other regions. 97% in Australia. Holding details, we've got a more granular view of the actual companies that we hold. So when we were up here and we had financials 29.1%, and that's the banks, basically, the big banks. So you can see here, we've got CBA, Commonwealth Bank, 8%, CSL, that's healthcare, BHP. These are the biggest companies. So when you buy the ASX 300 index, you're not buying an equal piece of every one of the 300 companies. You're buying a weighted average of the biggest companies in there. So even though 300 companies, one of those 300 companies is really a third of a percent of the 300 companies, 1 divided by 300, you still get Commonwealth Bank at 8%. So if the bigger companies tend to make up a lot of the ASX 300, then you're going to get that equal piece of the bigger companies, not necessarily a one-for-one basis, but exactly how much they make up of the index, if that makes sense. So it keeps going down. So you can see we've got 2% of Telstra, Rio, plenty of information there for you to have a look at. We're going to move along to performance. Now here we're comparing the performance of VAS, the index itself, to the benchmark ASX 300. Because all VAS does is basically seek to replicate the ASX 300. It's pretty close, but it's not exact. But you can see here, yeah, it's pretty close. Over the year to date, year, 3 years, it's pretty close. Risk and volatility. Now, beta of 1. Beta that is greater than 1 indicates that the securities price is theoretically more volatile than the market. For example, if a stock's beta is 1.2, it is assumed to be 20% more volatile than the market. Now, what that basically means is, if the beta here is greater than 1, if the market went up, say, 100 points, then this share, VAS in this instance, you might expect it to go up 120 if the beta was 1.2. So it's a little bit more volatile. If it's less volatile, it would basically mean the stock is moving less than the benchmark index, so it's less volatile. Because the VAS tracks the ASX 300, which is the market in this case, it has a beta of 1. If this beta was a long way off 1, whether it was like 1.2 or 0.8, you would say it isn't doing a very good job at tracking the market. So that's what you'd expect. You expect a beta of 1 here. Now the alpha rate. Alpha represents a percentage that reflects how an investment performed relative to the benchmark index. A positive alpha of 5 means that the portfolio's return exceeded the benchmark index's performance by 5%. Now, because VAS is so closely replicated to the benchmark, you would expect the returns to be exactly the same. That's why it's 0. If it was outperforming the benchmark, like if you're comparing a singular stock, like BHP for instance, to the market, you're going to have different figures here because BHP will either return more or less. So if it returned more than the market, you'd have a positive number. If it returned less than the market, you'd have a negative number. And the standard deviation is basically how much returns vary from the average. So if you've got your average return, and then you've got 17% standard deviation, that means the real return, or the actual returns, because they're going to change, go up and down over time, tend to deviate about 17% from the average returns. This sort of is another measure of volatility. And I've got a definition here. Standard deviation helps determine market volatility or the spread of asset prices from their average price. When prices move wildly, standard deviation is high, meaning an investment will be risky. Low standard deviation means prices are calm, so investments come with low risk. So here we've got about a 17% deviation from the average. Prices and distributions. Okay, so we just got some information here. Units on issue. And this was on the other overview screen as well, I believe. $96 net asset value. And then we got some charts here of the net asset value. You can change the term. So you can see for 12 months, this is what it's done. And we know from before that net asset value on ETFs are pretty close to the trading price. And we can see that here, where it's got the days down here, it's got the buy price, the sell price, and the net asset value. It's all the same. Distribution history. CPU is your cents per unit. So if you own 100 units, you're going to get 55 cents per the 100 units. So 55 cents multiplied by 100, that's what you're going to get. $55. Ex-entitlement date, that's your ex-dividend date. So for the distribution on 30th of June, if you buy your stock on the 30th of June, you're going to get the distribution. You're going to get the dividend payout for the 30th of June. If you buy it on the ex-entitlement date or the ex-dividend date, as it's commonly known, so if you buy it on the 1st of July, you're not going to get this payout because you bought it after the ex-dividend date. You're going to have to wait till the next quarter before you get paid. And that's why often when stocks go ex-dividend, they usually drop in price the next day. Because if you've bought the day after, you're not entitled to that dividend for that period. You have to wait till the next dividend. Or another way of looking at it is the market cap of that company goes down when it pays out a dividend, because that's cash that's coming off out of the company's bank accounts, being paid out to shareholders, so it's not worth quite as much more today as it was yesterday before it paid the dividend. So that's why the price normally comes down when a stock goes ex-dividend. All right, so this is Vanguard, which is a pretty big fund all around the world. Now we're going to go have a look at Ishares, which is BlackRock, which is another pretty big asset management company. And here we're looking at Ishares S&P 500 ETF. This is your top 500 shares on the US stock exchange or the New York Stock Exchange. So we can see here their price is $606 per share, or the net asset value rather. Management fee of 0.04%, that's very low. And we've got a bit of outline here as to what IVV, that's the code here for the S&P 500 ETF, what it's all about. So exposure to large established US companies, low cost, and used to diversify internationally if you want to get a piece of the US market. The investment objective, performance, so total return over 1 year. This is your market return, so the price has gone up, plus dividends, total return, 32%. That's very good, but we came off a pretty low base a year ago. We've got some charts here. You can also open this up and change the timeline to see how it's gone over a particular period. So this is, if it started at 10 grand, you can see it's gone down for a while, and then it really sort of took off around 2013 onwards. It really took off. So whether that's growth has really taken off, or this might have coincided when quantitative easing sort of kicked off in a big way, that might have something to do with it as well, and low interest rates. So you got the total return of the index, or rather the ETF and the index, and you can compare them. Pretty close. Key facts. Net assets, you got 5 billion worth of assets there. The number of shares outstanding, and if you divided by the net assets by the number of shares, it should be pretty close to the net asset value. Rebalancing frequency every quarter, and then we got some similar ratios down here. So again, we got the PE ratio. You got some information windows popping up here. 33.63. That's what it's trading at now. Let's have a look at what the long-term average of the S&P 500 ETF is. The mean average of the S&P 500 P&E is 15.95. And we're currently trading at 33. So it's about double what it's normally at, double the long-term average. Now that would tell you, without looking at anything else, if you just wanted to take a quick snapshot, and nothing's like, for certain here, but if you took a very quick look at it without doing too much analysis, it looks overvalued. Or you can say it's definitely valued at, priced at double its long-term average. The trailing yield is basically, it's like the dividend yield we looked at in the previous example. So you're 1.08% of distributions. Companies in the US tend to pay out lower dividends than companies in Australia, and because of that fact, because they retain more money in the company, because they're not paying out as much in dividends, they tend to have more growth because the value is kept on the balance sheet rather than paid out to investors. Price to book ratio, 4.79. If we look at the long-term average, S&P 500 price to book value, long-term average is 2.89. And we're trading at 4.79. So again, we're about double, bit less than the long-term average for what the price is trading at compared to the book value of the underlying 500 companies. So again, from that perspective, it does look a bit overvalued. Now here we got sustainability characteristics. Talking about ESG here, that's your environmental, social, and governance, or sustainability reporting as it's sometimes referred to, or triple bottom line reporting as it's been referred to in the past sometimes. I'm not going to get too much into this in this video. I'm just looking more at the financial aspect, but if you're looking to invest on environmental, social, governance grounds, then this is things that you might look at. I'll probably do another video about this. Business involvement, 0.78% are invested in controversial weapons, nuclear weapons, civilian firearms, tobacco, etc., coal, oil sands. So if you're an ethical investor, or if you're looking for an ethical investing exposure, you would look at this stuff. But for the sake of this video, I'm more looking at the financial aspects. And then we got the holdings, which is just saying that most of it, if we scroll over, you can see 99.98% is in the actual core S&P 500 ETF funds, and we have a small amount in AUD, USD, and AUD, USD foreign exchange. Very small amount. Now this is giving you a breakdown by sector. So an interesting thing here, we saw in the last example when we were looking at the VAS that about 50% of the VAS, the ASX 300, is made up of miners and banks. Now here in the US, the biggest sector is IT, and that's not surprising at all because you've got all your FANG stocks like your Facebooks, Amazons, Netflix, etc., Google, Microsoft, all those guys. Financials is only 11%, and materials is way down 2.49%. So this is very different makeup to what you have on the Australian Stock Exchange. So that's another reason why diversification is good internationally, because if you just invest in the Australian market, you're getting a very broad exposure to the banks and to the miners, but you're not getting much at all as far as big tech goes. And we've got literature, so you've got fact sheets and your product disclosure statement and all that kind of stuff. So that's pretty much it, guys. This is just a brief overview of how you might, or the things that you might look at when you're weighing up whether an ETF is the one for you. There's a lot of different ones on the market. They're bringing out new ones all the time. So whether you're, depending on what kind of exposure you're looking for in your portfolio, there's a lot out there. So get out there, have a bit of a look around, and you don't need to be a financial genius or an investment expert to be able to do some basic high-level analysis. Even just looking at very basic things like the PE ratios and that sort of thing. It's not too hard to get a grasp of that when you compare these to the long-term average and that kind of thing. But then it is hard because these days everything looks a bit expensive. So then you got to sort of ask yourself, well, you know, you got to put your money somewhere, don't you? All right, guys, that's about it for the video. Thank you for watching to the end. All this was a bit of an example of the things you can look out for when making your own decision. Go ahead, jump online, look at Vanguard, look at BlackRock. There's others out there as well. You'll see them when you're doing your research. Look at all the ETFs, see what's right for you. There's a whole myriad of different ETFs that look at different parts of the market, different sectors, different parts of the world, ethical investing, sector-based investing, all kinds of different things, and there should be something there to help you basically meet your investment goals. So jump on, have a look, and see what you can do. If you like the video, if you think I've helped you at all in any way, I'd really appreciate a hit of the like button. If you want to see more videos, please hit subscribe. But other than that, guys, thanks a lot for watching, and we'll see you in the next one.